If you are a federal employee age 55 to 65 with 500,000 to 2 million in TSP and you want to retire without surprise taxes or higher Medicare bills, this is for you. I'm Tom, a certified financial planner, and today I'll show you 3 legal moves you can use in 2025 to keep more of your money. First, we'll mark when the IRS makes you take money out and how that could raise your Medicare 2 years later. Second, we'll pull some money out early on purpose or move some to Roth to shrink those future hits. And third, if you give to charity, I'll show you how to give from an IRA so it counts towards your withdrawals without raising your income. So let's get into it. Here's the first thing to understand. Required minimum distributions start at age 73 for most people now. If you're still working for the federal government at 73, you can delay TSP RMDs until after you retire. But once you separate, that grace period ends. And here's a sneaky trap a lot of retirees miss. If you wait on your first required withdrawal, you can push it to April 1st of the next year, but you still must take the second one by December 31st of that same year. That puts 2 withdrawals on 1 tax return. 2 checks in 1 year can push you into a higher tax bracket. Now let's use some simple numbers. Say your first withdrawal is $40,000 and your second is $40,000. If both land this year, that's 80 grand added to your income. That can bump your tax rate and raise future Medicare costs. So the goal is to plan the timing now. Here's how we keep your income under the lines that trigger higher taxes or Medicare bills. First, a quick win you can use right away. Starting January 1st of 2024, the Roth side of your TSP does not have lifetime required withdrawals. Only the traditional side counts for forced withdrawals. That change came from a new law that took effect in 2024, so the TSP updated its rules to match. In plain English, dollars in the Roth TSP do not get forced out later. Dollars in the traditional TSP do. So moving money to Roth over time can lower future forced income. Now, let's talk about Medicare in simple steps. The base Part B price in 2025 is $185 per month, but Medicare can charge more if your income is higher, and this is called IRMAA. They look at your tax return from 2 years ago. If your income goes over set limits, your monthly price goes up in steps. Think of it like stairs. Cross a line and you step up to the next price. Here are the 2025 lines for couples filing jointly. The base price is at $212,000 or less. Then the steps go $212,000 to $266,000, then $266,000 to $334,000, then $334,000 to $400,000, then $400,000 to $750,000, and above $750,000 is the top step. If you file single, use half those numbers starting at $106,000. Each step adds more to your Part B bill. Part D can add more too. Even $1 over a line puts you on the next step. A bigger forced withdrawal can push you over that line 2 years later. Now here's a quick picture to make this real. If your forced withdrawal bumps your income from $211,900 to over $212,000, you just crossed the first line for couples. That small jump can raise your monthly Medicare price for the whole year. That is why we plan the timing and the size of withdrawals before they hit. Now that you know the rules, let's put your numbers on one page. Move number 1 is simple. We map your risk. Before we fix anything, we need to see it. Step 1, we list what you have today. Your TSP split between traditional and Roth and any IRAs, your planned Social Security age, that gives us a clean starting point. And step 2, we project your forced withdrawals starting at age 73. If you plan to work past 73, we also show the delay rule and the double withdrawal trap, when April 1st and December 31st land in the same year. Now, 2 checks in 1 year can spike your income. We mark that clearly. Step 3, we lay the Medicare stairs on top. These are the income lines that raise your monthly price. Medicare looks back 2 years, so the income we show for this year can change your bill 2 years from now. We highlight any year you step over a line. If your income is close to a line, even a small forced withdrawal can push you over it. Cross the line, you pay a higher price. Stay under it, you keep the lower price. Seeing this on one page makes the choice really easy. Your takeaway is a simple map. It shows 3 things: your forced withdrawal amount each year, the Medicare line for that year, and how much room you have before you cross it. This tells us what to do next. Now, in the next move, we use this map to pull or convert the right amount on purpose so you keep more and avoid potential Medicare hikes. Move 2 is simple. We make your future forced withdrawals smaller. Here's the goal. Before age 73, we move dollars out of the traditional bucket and into places that don't force you to pull money out later. Smaller forced withdrawals mean lower taxes and a better shot at keeping your Medicare bill low. So here's how we do it. We set 2 lines on your page, a tax line and a Medicare line. Then we move money up to the line, not over it. If we cross a line by even $1, we can pay more tax now and a higher Medicare price 2 years later. So we fill the space under the line on purpose, and then we stop. Here are your options by timing. If you want to act in 2025 and you have already left federal service, we can roll the right slice of your traditional TSP to a traditional IRA and then convert that amount to a Roth IRA. That move is called a Roth conversion. It shows up as income in that year. You pay the tax from cash so the full amount can grow tax-free. Starting in January of 2026, the TSP will let you convert inside the plan from your traditional balance to your Roth balance. You can use this if you're still working or if you're already retired. The amount you convert is added to your income for that year, but plan to pay the tax from cash outside of the TSP. You cannot withhold an amount for taxes within the plan. If you do not have a Roth balance yet, your first conversion will create one. Now, here's why this works. Roth dollars do not have lifetime forced withdrawals. Traditional dollars do. Each dollar we shift early is one less dollar the IRS can force you to take out later. That can help you stay under the income lines that raise your Medicare bill. Here's a quick picture with some numbers. Let's say your tax line has $30,000 of room this year, and your Medicare line has $25,000 of room. We use the lower number. We convert $25,000. That fills the space under your Medicare line without stepping over. Next year, we check the lines again, and we repeat the same process. Step by step, the traditional bucket goes down, the Roth bucket goes up, and your future forced withdrawals shrink. Here are some common rules to keep you safe. Move in small bites. Do this every year instead of one big chunk. It's easier to stay under the lines. Watch the 2-year Medicare look back. Income this year can raise your Medicare bill 2 years from now. We plan with that in mind. Pay taxes from cash. Do not withhold from the conversion. Keeping the full amount invested is what makes the math work. If you plan to work past 73, we also plan around the 2-in-1 year trap. We do not want timing to double stack your income and increase your taxes. Now that you see how we can shrink the future hits, the next lever is how to give if you are already charitable. We can give in a way that lowers income and still counts toward your withdrawal. Move 3 is to give smarter. If you already give to charity, here is a simple way to do it and pay less tax. After age 70 and a half, you can send money straight from an IRA to a charity. And this is called a qualified charitable distribution, and it can count toward your yearly required withdrawal. It does not show up as income on your tax return, and that helps with taxes and with helping manage your Medicare costs. You cannot do a QCD from the TSP, so we roll the right slice of your TSP to a traditional IRA first, then we send gifts from the IRA to your charities. The yearly limit changes over time. We'll use the current year limit for your plan. Here's a quick example. If you plan to give $10,000 this year, a normal check raises your income. A $10,000 QCD from an IRA does not. You give the same gift. You keep your income lower. Lower income can help you stay under the Medicare lines 2 years later. There's 2 guardrails to be aware of here. First, the money must go directly from the IRA to the charity. Do not take the money first. Second, QCDs work only for IRAs, not for donor-advised funds or private foundations. We'll keep it simple and do it the clean way. Big TSP balances are a blessing. Without a plan, they can create extra taxes and higher Medicare bills year after year. When you map your risk, shrink future forced withdrawals, and give the smart way, you turn a tax bomb into a calm, steady income plan for travel, family, and freedom. Here's your next step. If you want help, click the link below the video and we'd be happy to chat. On our short call, we'll review your tax map and lock in a plan. But if you're not ready to talk, that's completely okay. Watch my next video here, Avoid the 62 FERS Cliff. I'll show you how to bridge the gap when the FERS supplement ends so your income stays steady throughout retirement. Click here to watch, and I'll see you over there.